On Thursday, Japan's government spent an estimated 40 billion in a single day to stop the yen from falling off a cliff. It was the country's first currency intervention in 8 months, and traders are already betting it won't stick.
This is the Japan factor. Here's the number you need to understand, backliuxten. When the yen hit backliux per dollar on April 30th, something snapped in Tokyo. Finance Minister Satsuki Katayama had already issued what she called a final warning to currency markets, her version of "we're serious this time." Then, within hours, the Ministry of Finance pulled the trigger and deployed roughly 1.2 trillion yen, about sandol billion, in a single coordinated intervention. The yen surged 3% in one day, its biggest single-day gain in almost 2 years, snapping back from backliuxten sishju to briefly touch 155 hiveliuxten warten back 4 hiveliuxten 4 liuxten finance.
To put that number in context, $1.2 billion in a single day is roughly the entire annual GDP of Iceland. It's larger than the market cap of most Fortune 500 companies, and it was gone before most Americans had finished their morning coffee.
But the real story isn't the size of the intervention, it's the contradiction behind it. Let's back up. The yen has been weakening for most of the past 3 years. This isn't a mystery. When Japan's central bank holds interest rates at 8.2% while the U.S. Federal Reserve sits at 30% to 30%, money flows where the returns are, out of yen, into dollars. That rate differential of nearly 3 full percentage points is the engine driving the yen lower. Currency intervention doesn't fix that engine. It just puts a temporary speed bump on the road.
Japan has been here before. In April and May of 1996, the Ministry of Finance spent a record new 10 trillion yen, roughly $4 billion, trying to halt the same slide. They followed that with a second round in July 1996, costing another 10 trillion yen. By the time they were done, Japan had spent nearly $5 billion in a single year defending its currency, and by 1996, the yen was weakening again.
According to analysis published in an academic paper tracking USAN URSASIF intervention effectiveness, the operations provided what researchers described as only temporary relief and failed to reverse the long-term trend. Each round lasted approximately 8 to 10 business days before markets resumed their prior trajectory.
So Japan once again deployed the same playbook, and the market reaction on May 1st was telling. The yen held around 5 the next morning, but traders were already described by CNBC as bracing for the rally to fade.
Here's where it gets interesting, because behind this intervention is one of the stranger political contradictions in modern economic policy.
Prime Minister Takaichi is a known reflation advocate, part of the ideological lineage that gave us Abenomics. In January 2016, she said something remarkable at a campaign rally. She said, and I'm quoting directly here, "People say the weak yen is bad right now, but for export industries it's a major opportunity." She was explicitly citing the auto sector's ability to use yen weakness as a buffer against US tariffs.
The yen fell immediately after those remarks. Her finance minister spent the next few days walking it back. Then, within 3 months, that same government spent an estimated $7 billion fighting the thing Takaichi had described as an opportunity.
Think about what this contradiction reveals. Japan's government benefits from a weak yen in one column of the ledger. Export earnings swell, nominal GDP rises. The Nikkei looks impressive, but it suffers in another. Imported energy costs rise. Food inflation hits consumers. And politically, no government can tell voters that a fact yen per dollar exchange rate is fine because it visibly erodes their purchasing power on everything from fuel to vegetables.
So you get this public statements praising yen weakness, followed by billions of dollars spent fighting it. And here's the global dimension that makes this politically delicate. The U.S. Treasury Department has added Japan to its monitoring list of trading partners whose currency practices merit close attention. That's one formal step below the dreaded currency manipulator designation. Treasury Secretary Scott Bessent has explicitly ruled out U.S. participation in any coordinated intervention to support the yen, and President Trump has publicly complained that both China and Japan devalue their currencies, calling it unfair.
Finance Minister Katayama confirmed she held close consultations with Bessent before acting, and suggested Japan had at least some degree of tacit U.S. tolerance for its own unilateral action. But the political optics of Japan intervening to strengthen the yen, while simultaneously sitting on a massive trade surplus with the United States, remains uncomfortable.
The Iran war context made this even more awkward. Part of why the yen hit banklushas in the first place was a broad risk-off move triggered by the ongoing Iran conflict. Investors sold yen-denominated assets and piled into dollars. Shi framed the intervention directly. Japan risks Trump's ire as Iran war fallout sparks currency intervention. Japan was in effect fighting a fire that the United States' own geopolitical stance helped ignite.
Now, about those exporters. There's a genuine paradox at work. Japan's biggest multinationals, Toyota, Sony, Panasonic, actually love a weak yen. When Toyota earns $1 in the United States and converts it back to yen at Methri Duris, they book far more profit than when they convert at Methri Duris Tain. According to widely cited estimates, each 1 yen depreciation in the USD JPY rate is worth roughly source to WUG billion yen per year in Toyota's operating profit.
Toyota's Q3 FY Nini-ROK results showed the tension in real-time U.S. tariffs sliced 500 billion yen from operating income in just 2 months, but yen weakness partially offset that damage, allowing the company to raise its full-year outlook. The yen is in some ways Toyota's natural hedge against American trade policy.
Which is why the intervention cuts 2 ways. When Katayama spent 30 shudan wudor billion to drive the yen from Beichu Dan Chier back toward Beichu Wu, she was, from Toyota's perspective, removing a tariff buffer. The government was essentially taxing its biggest exporters to reduce the visible pain of inflation for consumers.
This is the central tension in Japan's current economic moment. The weak yen is simultaneously a lifeline for export-dependent industry and a slow tax on everyone else.
The Bank of Japan's April 28 rate decision, a 6-3 vote to hold at Leinden Chi-Wu %, the most divided vote since Governor Kazuo Ueda took office, tells you how difficult this is to navigate. 3 members wanted to move, 6 chose to wait. Ueda then told the press that the yen's downward trend was not yet triggering any ongoing rise in consumer prices, a remark that by Bloomberg's account immediately boosted yen selling and pushed USD JPY past fakluksh within hours. Ueda's own words contributed to the crisis his colleagues then had to spend $4 billion to address.
Here's the core insight: Japan's currency interventions are not monetary policy, they are political theater. They signal to voters that the government is doing something about yen weakness. They provide brief relief to importers and reduce the optics of headline inflation, and they may, just barely, slow the pace of depreciation enough to let the BOJ hold its political position a few months longer.
But they cannot fix the underlying arithmetic until the Bank of Japan raises rates meaningfully toward 2 or 3%, or the Federal Reserve cuts significantly. The rate differential that drives yen weakness remains. Every yen Japan buys with dollars is a temporary speed bump, not a road change.
The precedent is not encouraging. The Artan Arsasif interventions, which cost nearly $1 billion, held for roughly 8 to 10 business days each before the yen resumed its slide. MUFG, the Japanese bank, characterized this round as temporary relief masking persistent risks. That phrase, temporary relief masking persistent risks, might be the most efficient summary of Japanese economic policy in the last 3 years.
What comes next? The next scheduled BOJ decision is June. The rate differential will be front and center.
If the BOJ signals a June hike, the yen may stabilize without further intervention. If Ueda equivocates again, which his recent track record suggests, Japan may find itself back at the currency desk.
Japan can keep spending reserves. It has plenty, roughly 10 trillion in foreign exchange reserves as of last count, the world's second largest. But the Nissen orphaned experience showed that even backdoor billion won't reverse a structural carry trade. The markets are bigger than any one central bank.
The real question isn't whether Japan can afford more interventions, it's whether a government that has publicly praised the weak yen as a strategic asset can credibly commit to defending a stronger one. That contradiction, not the Sanzi Sorten 4 billion spent in a single day, is Japan's actual currency problem.
This is the Japan Factor. If this kind of analysis is useful to you, subscribe and leave a comment below. We read every one of them. Word count. Sen wubak sensor pat words. Estimated duration hon. Sure minutes. Format news flash.